Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Merck stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Merck develops and produces medicines, vaccines, biologic therapies, and animal health products. Their biggest drug is Keytruda, a humanized antibody used in cancer immunotherapy. It also has several other drugs that generated over $1 billion of revenue in 2021. The company is headquartered in Kenilworth, New Jersey, and was founded in 1891. The ticker trades on the New York Stock Exchange, Deutsche Borse, Mexican Bolsa, Euronext Paris, Xetra, Vienna, EuroTLX, Swiss, Santiago, Bulgaria, Sao Paulo, Lima, Buenos Aires, and London Stock Exchange. Let's get started with the model. This is a large cap company, 222 billion market cap. They're trading at $88 a share, and they have 2.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. The company generates tons of free cash flow, $10 billion in 2019 and almost $10 billion in 2021. We don't have their trailing 12-month number, so I used 2021 for the trailing 12 months. They did publish their first quarter financials, so we have the trailing 12-month number for their net income and revenue. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that peaks in the trailing 12 months at $13.5 billion. Revenue is the sales for the company, and that goes up each year from $47 billion to $52 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was highest in the trailing 12 months at over $37 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that was also highest in the trailing 12 months at $15.5 billion. They usually post a gain in other income and expenses. These are all the gains or losses not part of the company's core operations. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which was highest in the trailing 12 months at $13.5 billion. This is the company's most recent income statement. In the first quarter of 2022, their revenue was $16 billion. That's a lot higher than the first quarter of 2021 of $10.6 billion. You can see Keytruda was their biggest revenue generating drug at $4.8 billion. Of that $4.8 billion, $2.8 billion is in the US and $2 billion international. Gardasil was $1.5 billion. And you can see from this list they have lots of drugs they're actively selling. And here's the rest of their drugs they're selling. They sell medicine for animals, and that was $1.5 billion of revenue just in the first quarter. Their cost of revenue is $5.4 billion, SG&A $2.4 billion, R&D $2.6 billion. Their operating income is $4.9 billion, which is a lot higher than last year of $3 billion. Their earnings per share in the first quarter was $1.70. Which is about 60% higher than the first quarter of 2021. Their EPS in the third quarter of 2021 was the highest at $1.81. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. 2021 was their best year at over $14 billion of cash flow. They spend a lot in CapEx. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. They have tons of free cash flow, so they do pay a nice dividend. They also buy back lots of stock, $800 million in 2021, $1.3 billion, $4.8 billion, and over $9 billion. Every time a company buys back common stock, it decreases the shares outstanding. It makes your shares more valuable. In 2019, 2020, and 2021, they added more debt than they paid down. It looks like in 2021 they may have added debt to acquire some companies since their investing cash flow was $16.6 billion. When you acquire another company, the cash you pay for that company goes into investing cash flow. Also, when you sell a company, the cash you receive goes into investing cash flow. Let's look at the capital structure. $38 billion of equity, $33 billion of debt. They're 54% equity, 46% debt. and their net debt is $25 billion. This blue line is their equity balance since 2015. For most of 2020, their debt balance was higher than their equity balance, but it looks like for most of 2021, their equity was higher than their debt. And this green line is their cash balance, so they do keep a lot of cash on their balance sheet at any given time. I gave them the middle whack on Finbox, 6.3%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $296 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $267 billion. We divide that by 2.5 billion shares. And we get a calculated stock price of 106. They're trading at $88, so they're trading at a 17% discount. It's a buy according to the model. I did a video on this company in December of 2021. They were trading at $76. My price target was $96. They're currently trading at 88, so they're getting close to my price target. But now with their first quarter financials, my price target has gone up a little to 106. Their 2024 revenue target is $59 billion. 2023 is $56 billion. 2022 is $58 billion. That's how I got their future revenue estimates. And to calculate 2025 revenue, I just grew it at a similar pace from the prior 2 years. They convert on average 18% of their revenue into free cash flow, so I multiplied their future revenue estimates by 18%. That's how I got their future free cash flows. The website Simply Wall Street values the company at $223. They're saying it's 61% undervalued. 11 analysts priced this stock and the average price target is 96, the lowest 87, the highest 107. This is where the stock has been trading the last 5 years. The stock was trading around $60 the second half of 2017 through the first half of 2018. And then starting around July 2018, it kept growing through the end of 2020 close to $90. And that seems to be the resistance point because it really hasn't broken through 90 since then. It looks like it hit close to 90 in October 2021, and now it's getting up there again. So we may see another pullback, or possibly it will break through the resistance point. They pay a quarterly dividend that they raise every single year. They're up to 69 cents a share. It's a dividend yield of 3.15%, which is 52% of their net income, 72% of their free cash flow. Their dividend yield since 2011 has been between 3 and 4.5%. And the forecast is for their yield to be 3.7% by 2024. They have a low beta, 0.46, so the stock is not volatile. It moves about half the market. It's gone up 22% in the past 52 weeks, while the S&P is down 1.5%. The 52-week low is 71, the high is 91. And the stock is on an uptick, trading above its 50-day and 200-day moving average. This is a pretty popular stock. About 11 million shares are traded each day. Pretty much all the shares outstanding are on float. 75% are held by institutions, and under 1% of the shares are shorted. They've done 7 stock splits in their history, a 3-for-1 in 64, a 2-for-1 in 72 and 86, a 3-for-1 in 88 and 92, another 2-for-1 in 99. It looks like they did close to a 1-for-1 stock split last year. This is probably from an acquisition. Their employee count is fairly steady over the years. It has gone down a little bit the past year. They currently employ 68,000 people. The CEO's salary is $1.3 million, and their total compensation package is about $14 million. This orange dotted line is their earnings. But the CEO's total compensation package was higher than their earnings in several years. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $33,000 today. That's a 13% annual return. 74% of the company is held by institutions, 26% by the general public, and only 0.07% by insiders. Vanguard is the biggest shareholder at 8.3%, then BlackRock, State Street, Wellington, and Geode. Let's look at their financial ratios. They have a pretty good PE at 16.5. That's stock price over earnings per share. Better than the market median and market average. Price to sales of 4.2. Price to book of 5.8. They have a high return on invested capital of 20%. They can easily cover their interest payments with their operating income. A really high ROE of 35%. That's net income over equity. They have a good current ratio of 1.3, that's current assets over current liabilities, and their quick ratio is slightly above 1. They generated $10 billion of free cash flow in 2021. They have over $6 billion of working capital, and they pay out $7 billion of dividend payments, so the company's well funded. The best way to look at ratios to compare them to companies in the same industry. There are 18 companies in the same industry as Merck, and if Merck has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're better in most categories. They spend a lot on CapEx. Their debt to equity ratio is a lot better than average. They pay a higher dividend than average. They generate a similar amount of free cash flow as the average company. They rank 5th in market cap. Their price to book and price to earnings are a lot better than average. Their price to free cash flow is a little worse than average, and their price to sales matches average. Their 3-year annual revenue growth rate is low at 5%, same as Johnson & Johnson. But Eli Lilly, Pfizer, and AbbVie are much higher. So to summarize, I have them trading at a 17% discount. This is a really solid company. They have tons of drugs that are FDA approved. And not only that, they have many drugs that generate more than $1 billion of revenue in a calendar year. Because even if a patent expires on 1 or 2 drugs, it shouldn't be too much of an issue. Because they have lots of revenue generating drugs, plus they have lots in the pipeline. I rank their free cash flows 8 out of 10, their revenue 9 out of 10, and their ratio 7 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.